Welcome everyone to another Hurley Investments short educational video. My name is Kevin Hurley. I'll be with you today to go over what is a short call option. It is sometimes called a naked put, but we're going to talk about that one later. For those that are new to options, what is an option? It's a derivative that derives its value and purpose from the stock that's associated with. There are something called Greeks that I will do a Greeks class for you, but for the most part, to keep it simple, it's a derivative that derives its value and purpose from the stock that's associated with. In general, an option is a contract that gives the purchaser/seller the right or obligation to sell or buy the underlying stock at a predetermined price for a predetermined period of time. That's a mouthful, but that is all options are in that one sentence. If you buy an option, it's a right. You're buying the right to do something. You're spending your own money that you get to do something. Whereas if you sell an option, you take someone's money, you're now obligated to do something. Although it's also used with although it's often used with stock ownership, a short option can be sold without it. I would recommend against it. That's when it's defined as a naked option. I'm going to go over the risk associated with that in our last slide, but usually options can be used with stock ownership, or you could use two options together to create a spread trade. One option contract controls 100 shares of an underlying stock. So let's get to a short call option. A short call option is that derivative, and its sole purpose is to sell the option. That's you're selling it, and either keep the credit that someone pays you as it expires worthless, or to call away your stock ownership or an option that you associate with it. You're going to choose which one that's going to be. The contract, the seller of the option, is obligated to sell the underlying stock at a predetermined price for a predetermined period of time. Now, this option makes money in a little bit backwards way of thinking. The short call decreases in value, which is what you want, as the underlying stock price goes down. So let me give you an example. If you're obligated to sell stock to someone at $100, if the stock goes down to $80 a share, they're not going to want to buy yours for $100. Even though they paid you some money, no one wants to go buy stock from you at $100 if they can buy it for $80 on the open market. So as you saw the word decrease in value, if someone gave you $1,000 and it decreased in value or expired worthless, that means that $1,000 is yours. Sometimes you might get a $1,000 credit, and after 500 of it evaporates, you might buy it back for 500 bucks. Sell something for 1,000, buy that same thing back for 500, you make $500. It's a bearish position to own that makes money in bearish markets. Remember, one call option controls 100 shares. So if you wanted to sell 500 shares of Apple, you'd probably need, or not probably, you would need 5 contracts to be obligated to sell your Apple shares at a certain price for a certain period of time. It's also referred to a naked call, which has unlimited risk if it is not associated with a stock position or another option. You still open the position to get a credit into your trading account. To get an example, this is an option chain. Again, I keep using Apple, so let's talk about Apple. Apple is defined in that upper left-hand corner. When we took this picture, if you look right underneath it, beginning of October, Apple's trading at 224.59. After hours, it's a little bit higher than that, 225.12. So if I was looking at my option chain, the first thing I would do is take a look at my call side, and then I'm going to focus on what time period I want. I would always recommend 30 days or less. For this example, we're going to use the November monthlies because that's the chart that I snapped, but that's usually 15 days more than I would expect to have a short call in play. You typically want these to expire worthless as quickly as possible. If we went out to 45 days, that would give us a little bit of credit to cover through a very volatile October and also to cover us through earnings for Apple. It's usually the end of October. I would take a peek at my strike price. Where would I choose to be obligated to sell my stock at? For me, getting into Apple to $150 a share, I would probably choose that 225 strike price. It's right where the stock is trading right now, which is very close to an all-time high. If I sold my stock at 225, that's $75 or a 50% return on my purchase price. 50% return on Apple shares, pretty good return, right? So I would take a peek and say, hey, let's look at the option price in the bid column. For me, it looks like it'd be $8.70 I could get per option. One contract, though, covers 100 shares. I could choose higher in that green there. I could do 250, maybe sell my stock at 250, but you'll notice I'd only get $1.02 credit for doing that. If I chose to sell it at 220, I'd get a bigger credit of $11.55, but I'd be selling my stock about $5 cheaper than I could at 225. The 225 is called at the money, and that's usually the best bang for your buck. When you buy or sell, buying and selling call options in general, right? You always buy at the ask and you sell at the bid, which means if I was to create this position, I'm going to sell to open at the bid price. So I'd go over to my bid column. I'd sell at $8.70. If I wanted to close it, a week from now, I'd have to go to the ask column and buy it back at that price. You'll notice that's at $9.10. Doesn't make sense to sell something at $8.70 and buy it back at $9.10. You'd lose 40 cents. That 40 cents is called the spread, and it's what the money makers get to make sure they put buyers and sellers together. And if there aren't some buyers or sellers, they use their own shares to fulfill those obligations. We're selling a short call option that obligates us to sell stock at that strike price that we choose. I've chosen the 225. I've chosen that because if I did one contract, I get $8.70 per share times the 100 shares for one contract. I would get $870 credit into my account. My real sale price, because I'm going to get to keep that credit of $8.70, I sell at $225, I keep the $870. It's like selling my stock at $233.70. Now, if Apple trades higher than that by the third Friday in November, I could have done better just holding on to my stock for that 6 or 7 weeks and selling it later. But I've got $8.70 that if the stock fell below 225, that's going to expire worthless, and I get to keep that $8.70. It gives me a little downside protection. In all honesty, if I did my math there, I would be about what? $216.30 is where, if it goes below that, I've made up the loss up until that point. There's something to remember, and I'm pulling this off of my several simple steps on how to short a stock with an option. The risk is unlimited if you use the short call option by itself. If you don't have an option or stock that's going to cover the obligation, you could lose a lot of money. This is the one option that makes trading options risky. The other three are very simple to use. They can protect stock ownership, but this is the one that gives options a bad name. What if your shares you're obligated to sell at 100 go up to 500 over the weekend on a new product announcement? You're obligated to sell shares of stock at $100. So if you went out there and had to go buy shares at $500, you literally would be buying 100 shares at $50,000 to turn around and have to sell them for $100 per share to sell them for 10 grand. Oh, that's like buying high and selling way low, right? You don't want to buy at 500, turn around and sell it at 100. You want to buy at 100 and sell it at 500. So this is the risk in the option. You are obligated to have to sell those shares. If you don't have those shares of stock or a long call option that acts like stock ownership, there's a huge risk in running the short call by itself. Understand you don't know what may happen as the markets are closed that could skyrocket those shares higher. So never use a naked call, use a short call. The difference, a naked call is just a short call by itself. A short call is an option position that's usually associated with stock ownership or that long call option that acts as stock ownership. Guys, I hope this was helpful for you. If you liked it or have any questions, obviously, please give me a call, toll free. You can always check on My Hurley Investments for some more of these videos coming out, or you could like us on YouTube and get them firsthand. Just subscribe, click on the bell to get a notice every time a new video comes out. If you do have questions or would like to ask me anything and just write it down, you can always send an email to support@hurleyinvestments.com. We appreciate you guys watching these videos, and we look to present some more out to you soon. Until our next video, take care.